Hey everyone, hope you're having a nice day. My name's Andy, channel's Finding Value. Today we're going to go through Twitter like we normally do each time. I'll give you my financial opinion as we go through it. It's going to be related to wealth building, commodities, and or financial topics. So let's dive in. Let's see what people are talking about, and I'll sprinkle in my opinion as we go. If you want to follow me, at finding_finance. And if you want to join our community where I do a lot of training and teachings on a lot of different things, technical analysis, it's all uploaded on the website. If you guys want to look at it, I also do midweek updates and uh, you can directly interact with me on Zoom meetings during the weekends. LEAP is our discount code, LEAP. So we got JR here. He says, despite closing up 2%, price put in a lower high and a lower low. So it is still in a downtrend mode. But, I would like to say that this is a bullish piercing candlestick. It doesn't necessarily mean that it will for surely reverse the trend. So in the short term, a lot of the times you've got downward momentum. It's got to work that off, but this could be the beginning of a downward trend reversal. It could be. I'm not stating it will be. It'd be nice to get a little bit larger volume on this candlestick, but a lot of the times what you see is you'll get these sideways motions here, and you can see a wick on the bottom like this bullish hammer candlestick, and then you get very little selling pressure. You get a nice big bullish engulfing here. That's the one right there. This is a bullish piercing here. You get a squeeze up and then a big move up. We're squeezing up right now, and sometimes they put a tail on these things, like a downward squeeze on it. And this is a bullish piercing. So a bullish piercing is this. I posted it on there. So it's a two candle pattern. It's a trend reversal pattern, effective if found during downtrend. So the first candle is a red bearish candle, which is this one. The second candle is a green bullish candle. Both candles should be big. Green candle opens below the red, so the opening price is below the closing price of the day before. And then it closes up greater than 50% of the candle before it. I know it's not on there, but that's the technical definition. So the green candle closes slightly below the top of the red candle. It's the 50 percentile, and you can see we gapped down low and came back up. All that means is that the momentum is coming to the upside. So we've got momentum going up, and let's hope that momentum can continue into other trading sessions. It doesn't guarantee that it's a reversal. It's all based off of basically momentum. So it still looks good, in my opinion, to try to move up. But again, I don't play the short term, guys. I've been burned enough trying to play the short term where, and I've made so much more money playing the long term that I don't find it worthwhile playing the short-term market movements myself. But it does look like we could try to turn. I wouldn't put a bunch of significance in it though. Most of the time, your biggest moves come from a basing pattern like this basing pattern, and then you break out of the basing pattern. You go from one level to a much higher level. Coming down, it says this guy is truly the biggest jackass financial influencer out there. Total cringe. He says Grant Cardone says earning $400,000 a year would embarrass him as a husband, father, and human being. How do you make sense of $35,000 a month? Guys, 400,000 puts you in. Now you wouldn't be in the top 1% of Colorado. I think that's like 6 or 700,000 would be the top 1%. But 400,000 would put you in the top few percent. Would be my opinion there. So I don't know what this guy's saying. If you can't live off of the top few percent, I don't know. But some of these guys, they really want to make a bunch of money. Like it's ingrained into their body, and that's what keeps them driving to make more and more and more money. It's not being satisfied, and maybe that's what he's got. I don't know, but that seems a little bit high. This is the March 24 Panamax trying to contract highs. So this is the dry bulk shipping. I look at this chart, it looks fantastic. We've got a little bit of a pullback there, comes back up. And to me, look at all the big green candlesticks, bullish engulfing, big bullish candlestick, bullish engulfing just occurred. We are squeezing up into a top here, which I think will probably break to the upside. So this is one to watch. Same with a lot of the tankers. The tankers look really good, along with the dry bulk shipping companies. And we've got exposure if you're part of the website to that. Coming on down, the top issues for young voters in 2024 per CNBC. So cost of living is the top issue for young voters in 2024. Mine would be taxes and government spending. Those are the ones that really impact me myself. Healthcare, yeah, I think the healthcare costs are absolutely ridiculous, but I don't know what government can do outside of just getting rid of anything that they're doing in the healthcare sector. Anything that government touches, it seems like the costs just go ballistic. And they're touching our money, and you know what the price of money is doing? Going down dramatically. So I would say cut government spending dramatically and then look at reducing taxes because as you climb the socioeconomic ladder, you really do start paying a lot in taxes. But it's of no surprise that young voters are definitely focusing on cost of living because that's where they are in their life. They don't make a lot of money. They're trying to work their way on up, and the cost of living is really hurting them the most. We got Patrick Karen here with bull mode resumes for crude oil below the thick rising trend line. So we've got, and let's look at this. I'm gonna have to shrink this up a little bit, get it in there. There we go. So bull market, uranium and oil, as it comes on down, it looks like it consolidates upward from 82 all the way to the breakout of about 1999. That's also when the commodity to stock ratio was at its lowest, was 98.99. Broke out, came on, oil running like a beast, a little bit of a consolidation there, another running like a beast, and it peaked out in 2008. We had a consolidation from '08 and a break in 2021. And we've been consolidating sideways here for a little bit. So that's what we've been doing is consolidating, in my opinion. And once we break down below that, it's the bull market for uranium and oil. Looking absolutely fantastic. We broke our first big trend line, which is very important. And the bull market's in progress. We're in the super cycle. People don't realize it yet because the beginning of bull markets run slow and they speed up with time. So the 2020s, the late 2020s, maybe even into the 2030s, is going to be a big bull market for uranium and oil. And I completely agree with this chart wholeheartedly. Wholeheartedly. And I think if oil does go up like I think it's going to go up, I think precious metals are also going to run with it, just like the 1970s and the 2000s. The AI data centers need so much power. They may need built-in nuclear reactors. So when these AI data centers, they need so much electricity and so much power. I do think eventually it's going to go to nuclear reactors. Totally agree. But in the short term, what's going to run these things? And I don't think the solar panels and wind is reliable enough and can generate enough power for these things. So I'm in the natural gas camp, but that's me. CCJ and DNN. So we are at similar to 2006 by the dips is what Hinster is talking about. This is what the chart looks like. You can see that in the yellow or the orange yellow, whatever you want to call that, orangish yellow is DML, which is DNN, the TSX, and you can see the big outperformance here. We've been moving on up, but we're still early in this, and I think what's going to occur is a lot of these smaller names will hopefully start to outperform CCJ. Now, are we going to get the exact repeat of the last bull market? I don't know. I know a lot of people are asking that. Is it going to be the same? Is it going to be this? I don't know, guys. I don't know if it's going to be exactly the same. But what I would look at is what are the market conditions? The market conditions that occurred here was only a credit expansion phase with no type of supply shortage. There was the threat of a supply shortage. This thing over here, I think we're getting supply shortage. So I think we're going to see a big move in a lot of these companies during this energy bull market. So yes, I understand some people say, well, it's not like the last bull market. Yeah, it's different. It's even worse. It's the intensity of the shortage should be felt here, and this was just the threat. So I'm in the camp that there's a lot of upside left, and if you start pricing these in terms of dollars per pound of resource, we're still way low compared to the previous bull market that these were priced at. Now, will those same valuations occur? I don't know, guys. Like, I really don't know. All I can tell you is that we're still very cheap and things have a long way to run to the upside, in my opinion. Here is MetaLink's Katniss. The big picture, the economy is in stage four and will be for a while, favoring energy, other commodities, and equities. Inflation will continue. What are your thoughts for pound uranium? So she thinks we're in stage four. I agree. We are in stage four. Now, some people think that we're over here where bonds and stocks and commodities go lower. In my opinion, we just entered. We're in stage three and four. We're going from three into four um, based off of the longer term cycle of the real estate cycle. The real estate cycle, we haven't built the homes, we haven't gone into some gigantic expansionary phase of real estate. What is preventing us from moving forward is interest rates. The interest rates went to, I think, a level that is probably too high for us to build all of the homes. And what put us to that level was the stimulus money. Stimulus money probably pushed rates a little bit too high. So they need to come back. Then they'll kick off a big housing market boom. And that will be the business cycle. And we'll go into a very inflationary period based off of the demographic interacting with the real estate market. And it's going to be very bullish for commodities, potentially stocks, and then commodities in a late cycle boom when we go into a hypersupply phase. We haven't gone into or even touched a hypersupply phase. That is why our inventory levels are so low. It puts us at the beginning of stage four, which makes this person very much accurate, in my opinion. We have a long way to go to build all those homes. We're super early, and we could even have, the stock market eat it at some point because interest rates could continue to go up at some point. So we might like cycle back down a little bit or go flat in interest rates, and they may have to raise them again if inflation gets out of control and depending on the shortages of energy. Energy is going to the shortage of energy out in the future. I think for the next 3, 4, 5 years or something like that, it could bring rates even higher. Possible. Because my issue with the soft landing fallacy is simple. Inflation and growth are very interrelated, but their causality is not stable. Any statistics literate trader and analyst knows and has struggled with this. Implications are important. Usually it's a two-way casualty, but this seems to be strongly influenced by inflation regime shifts. When inflation shifts materially higher, it starts to become a much more important growth driver. He's talking about GDP growth. For AI, fantasies about Bidenomics, it's nothing more than inflation-fueled growth wrapped in lots of PR. Agreed, it is inflation-fueled growth. Totally. This is not trivial, and it pertains to structural economic regime shifts. So it's not surprising that it flies above many heads, as most models' analysis are cyclical. Given growth priority of dying political regime system in the US and a vital necessity to service an exploding federal debt, you need growth to sustain growing tax collections. There's an upward inflation bias, almost a system survival necessity. Exactly right. Dilettante eyes attribute this to short-term absence of fiscal discipline and election economics, but the issue is much deeper. All this to say, there's now an embedded upward inflation drift coded into the system. That's where the second waivers get their obsession from. But banter economics aside, there's only one way out of this: crash it down. So the system, in order for the system to survive, and you guys have heard me say this before, it's got to have inflation. And they don't want the stock market to crash because a huge tax revenue from the stock market is being generated from higher prices. They're in a really bad situation here. And we could shrink real GDP but grow nominally. They need it to for the system to survive. It's embedded in the design of the system. And that's why he's saying the issue is much deeper. It's not just about fiscal discipline, it's about the system and the survival of the system. Hence why I'm such a gigantic commodity bull. They are screwed. They got to keep everything moving upward. So here for the oil bulls. What I'm saying, natural decline is, call it 6% on 103 million barrels. That's over 6 million barrels per day of capacity that is lost every year. That has to be replaced. So that is a Saudi Arabia every 2 years. And that's coming from the Saudi Arabia CFO. So that's what we're losing every year to stay flat. We need 6 million barrels, if it's a 6% decline rate. I've heard the decline rate is closer to 10%. It's 6% on the old stuff, 10% plus on the newer stuff. So yeah, we need a lot more oil. And I think there's going to be an energy shortage coming later 2020s. And that energy shortage is going to clash with the design of the system. The design of the system needs inflation. It must grow continually. And this is the natural constraint is oil. And every time oil had a constraint like the 1970s and in the 2000s, what occurred in the commodity markets? They went ballistic. Everybody started buying things that were hard assets. It's going to come again. And in my opinion, we are still early. We're in wave two of a little, move higher. We're in wave two of a little pullback in a move higher, I should say. And then I think the big move is going to come when the system design hits GDP constraints in oil. It's gonna be glorious, guys. It's gonna be a big move. The Fed's next move, a rate hike. And you can see that this is rent and all the other one, but core CPI is turning upward here just recently. It's bottoming and turning back up. Once the RRP, so that's the reverse repo, is drained, government spending is likely to slow, according to Morgan Stanley. Won't be too long now. So that may slow down in terms of government spending is what they've got, or they'll just do something different. We'll see. Okay, this dude posts a lot of great charts, but this one, how can you ignore it? So bank credit is contracting sharply. What is basically covering this, and probably why they're going to lower interest rates? This is my guess. The reverse repo is going to run out. They're going to lower interest rates, and then what's going to happen is bank credit's going to come back up to the upside. So they're going to replace the reverse repo that they were doing in the fiscal spending. They're going to replace that with monetary expansion of bank credit. So this is going to come back up when they lower interest rates, and this is going to go back to nothing. That's my guess. So she says, when is this going to occur for the XEU to gold ratio for the gold and silver mining companies to break higher? I would look for a decline in interest rates. A declining interest rate environment where the yield curve uninverts is where I think this will start to change. That's my win. When will that occur? The uninversion of the yield curve? I don't know. I don't know. The nuggets section on our website features all the 2023 IGWT report chapters. So this is what they've got: a crack up boom, the end of the currency regime. The system design is causing a crack up boom. So a breakdown occurs, the crack up boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. That's the crack up boom, according to Ludwig von Mises. Geez, I butcher people's names. That's what's going on. And soon we're going to be transferring that money as quickly as we can for real goods. I agree. Price growth since 2020. So food is up 25%, rent is up 22%, gasoline's up 22%, and core CPI is up 18%. Wow. All these are larger. It's because of hedonic adjustments and substitutions and all the games they play. And they're probably drastically understating this, guys. I just came back from uh, picking up some groceries. I'm like, dude, eggs are still going up again. I'm like, come on. And I'm seeing price increases on like everything again. I'm like, stop with this. Just stop. But nope, it just keeps going. Cost of living increases in one chart. We are not only paying more, we are getting less, not only in the UK. This is real versus nominal. You can see real that it's going down, and you can see nominal pricing going up. So retail sales, yeah, they're going down. The sales are. But in terms of nominal pricing, it goes up. So they're charging far more for less stuff. That's what's occurring. And that's what I've got for today. So give me a thumb up for the content, subscribe to the channel, check out the website if you're interested. And that's all I've got. So we'll catch you next time. This is Finding Value.